Bain Capital Specialty Finance reported a mixed Q2 2026 today. I mean, they delivered a bottom line beat, but really missed the top line consensus.
Right. Net investment income came in at 44 cents per share, which, just edged past the 43-cent expectation.
Yeah, but revenue hit $62.35 million, missing the $64.44 million mark. And looking at guidance, management is maintaining their 42-cent dividend for Q3.
They are, yeah.
Yeah.
But they definitely put a pin in it for the future. They explicitly stated they'll be reevaluating upcoming dividend levels based on where interest rates go and, well, their impending debt maturities.
Which makes sense. But man, the market did not like this print at all. Shares dropped 1.7% in pre-market, down to $12.73.
Yeah, hovering right near 52-week lows.
Exactly. We even saw Keefe, Bruyette, and Woods immediately downgrade the stock-to-market perform. So that's our mission for today's deep dive. We're unpacking BCSF's latest earnings report and analyst notes to figure out exactly why a so-called earnings beat triggered such a massive market sell-off.
Because honestly, this quarter feels a bit like bragging that you beat your household budget, but only because you sold off your living room furniture.
Oh, wow. That is a perfect way to look at it.
Right. Because when you dig into how they actually achieved that 44-cent EPS beat, it wasn't through organic growth at all.
No, total investment income actually fell 12.1% year over year.
Exactly. They hit the target through aggressive expense reductions. They slashed costs down to $33 million.
Right, and you just can't shrink your way to long-term success. Plus, the portfolio itself is physically contracting.
Yeah, it really is.
We're looking at a $2.36 billion portfolio that just experienced negative net investment fundings of $95.2 million. So, in plain English, they had way more capital flying out the door in loan repayments than they were successfully deploying into new investments.
Though, we should give credit where it's due. Their joint ventures did provide a rare bright spot.
Oh, right, the senior loan program.
Yeah, the SLP specifically managed to return 18%. So by focusing capital in that specific joint venture structure, they extracted some impressive yield, even while the broader direct lending book shrank.
Fair point. And, if you read CEO Michael Ewald's commentary, you would think everything is totally fine. His tone was highly optimistic.
Very optimistic. He stressed that credit quality remains, quote-unquote, healthy.
Yeah, and he made a point to say their 12% software portfolio is highly insulated from any AI disruption risk. But I really have to push back hard on that sunny narrative.
I'm right there with you.
I mean, it's like claiming your car is running perfectly because the radio sounds great while you're completely ignoring the blinking check engine light on your dashboard.
That check engine light is blinding when you look past the adjusted net investment income. You have to look at the true GAAP net income.
Exactly. Under generally accepted accounting principles, true net income was only 22 cents per share.
Literally half of the NII number they led the call with.
Right. Because NII is a great metric for tracking the cash generated, but GAAP forces them to account for portfolio markdowns. And they took a massive $14.6 million in realized and unrealized losses this quarter.
Yeah, you just can't wave that away. Those GAAP losses aren't just accounting noise. They represent the actual deteriorating health of the borrowers.
Right. We saw net asset value decline sequentially to $16.65.
But the real flashing warning light, the one that really explains the market sell-off, is the non-accruals.
You mean the loans where borrowers have simply stopped paying?
Exactly. Those non-performing loans more than doubled sequentially. They hit 3.2% of amortized cost.
Wait, doubled in a single quarter?
Yes. When you have bad loans doubling that fast while your top-line revenue is simultaneously shrinking, the market is completely justified in hitting the sell button.
Yeah, it definitely changes how you view their safety, which leaves you with something important to consider as you evaluate BCSF moving forward.
What's that?
Well, the company's structural defense has always been its asset mix. Specifically, that 63.4% of its portfolio is held in first lien senior secured loans.
Right. Theoretically putting them first in line to be paid if a borrower defaults.
Exactly. But if middle market credit stress continues to accelerate the way this quarter suggests, will being at the top of the capital structure actually be a strong enough shield? Or is that 3.2% non-accrual rate just the start of a much bigger breakdown under the hood?
Follow the show for daily earnings coverage.